Market structure is the central concept at the very core of pretty much every financial market. And if you're a price action trader, you need to understand everything about market structure because it directly refers to whether price is going up, down, or sideways. Without it, you'll be continually battling the market. And when you're fighting against the direction of the market, you're not going to have high win rates, you're going to encounter a lot of losses, and you won't be able to trade with clarity. So, in this class, I'm going to teach you everything that you need to know about market structure, from the very basics to some of the more intricate details that you can use in your own work. So, with that said and done, let's get to the learning. So, what exactly is market structure? Well, it simply refers to the trending direction of a market. And there are three different market structure phases that we need to be aware of. There are uptrends, consolidations, and downtrends. An uptrend is quite simply when the market is moving in an upward fashion. And obviously, through this phase of price action, we would only want to buy. A downtrend is, of course, the opposite, where the market is moving down. And through downtrends, we are only looking to sell. A consolidation is therefore just a range where the market is not doing a whole lot of anything, there's no clear direction, and throughout consolidation, we should just not take trades. Unless, of course, we have systems that allow us to take advantage of the liquidity in ranges. But for beginner and amateur traders, I would just focus on trading with the trend because that's where the big money's made, that's where the high probability is. So, to work out which way the market is going and to actually give an objective stance to identifying uptrends, downtrends, and consolidations, we use highs and lows. An uptrend is a market where we are continually forming higher highs and higher lows. So if the market is forming higher highs and higher lows, we know the market is in an uptrend, therefore we should only look to buy. A downtrend is the opposite. It's a market that is forming lower lows and lower highs. So every low is lower than the previous, and every high is also lower than the previous. Now, quite obviously then, a consolidation is simply where the market is trading sideways and not really providing any clarity. It could be forming equal lows and equal highs, or it could be forming a higher high followed by a lower low, followed by another higher high and another lower low. There's no direction in consolidations, therefore they're not the greatest place to trade. Every trending move in the market is made up of two different primary moves. We have impulse moves and correction moves. So an impulse is the pro-trend movement. So here in an uptrend where we're forming higher highs and higher lows, the impulses are the movements on the way to forming new higher highs, the larger moves, the reason that the market is going up. A corrective move is then the small pullback we get because markets don't move totally linear. We're never going to see a trending market go like this. There's always going to be small pullbacks within the price action, which make it more choppy like the one that I've just covered. This is because we have control from the buyers through an impulse move, and then some buyers will take profit, sellers will start to see opportunity. The market pulls back until it reaches a level where new buyers are happy to get in, and then we get that next pro-trend movement because the buyers overtake control from the sellers and we move into new highs. So that's why that works. Now, what we want to do when we're trading is look to capitalize on the impulse moves by buying in from the bottom of corrective moves. So our job as traders is to identify where the correction is and then use other concepts to work out where the correction is going to end. And we'll cover this a little bit later in the video. Then we want to buy in from the bottom of a corrective move. So our prime buying point would be pretty much anywhere at the bottom of these higher lows. And then we can take advantage of the impulse move for either a small trade or a larger pro-trend trade that we expect to hold for a longer time span. Now, for a selling phase in the market, things are pretty much exactly the same. So instead of having higher highs and lower lows, what we would have is a lower low, lower high, lower low, lower high. Now, these pro-trend downward movements are the impulsive moves, the large moves that form the reason that the market is going down. So these are the structural moves that are able to break past the previous lower lows and lead into continued downside. That is the impulsive move. Now, the correction or the corrective move is then going to be the small upward pullback that forms the lower high in the market. So whichever way we're going, we have impulses as the pro-trend movements and corrections as the smaller pullback movements. And this builds the foundation for the work that you're going to be doing with structure because we want to work with the trend. If we can use the higher highs, higher lows, lower highs, and lower lows to identify which way a market's going, then we can work out the impulsive and corrective moves. Now we have a solid foundation to start working off to actually start nailing some great trades. Now there's a question I want to answer before you even start asking it. And that is, why should we use raw price action structure over things like trend lines? If trend lines are easy to identify because we just connect some highs, we can get that done faster. Well, we're going to go through a real example here. This is a trend line, a downward trend line. So this is supposed to indicate a downtrend in price. So we can see we connected one high to another, and this is supposed to indicate the trend. So the concept then is every time the market retests this level, it should be moving into a new selling move. And if it doesn't, and it instead breaks upwards, that indicates a change in the trend. So when we see price action like this occurring, where we've broken above the trend line traders now see this as a trend reversal. And they will now look for a pullback and buying opportunity because they think that the market has changed direction, which is an easy mistake to make if you're trusting in trend lines. Now, I just want to give you about 5 to 10 seconds to review this structure. If you look at it from a lower low and lower high perspective, has the structure actually changed like the trend line suggests? Well, the answer is no. The structure hasn't actually changed. So we have the high here. Then we had a break of structure, which led us into a lower low. Then we had a lower high. Then we had another break of structure, which led us into a lower low. Then we had another lower high. Now we've come down and formed another lower low. If we take a look at where the price is now, it's below the previous lower high. So we haven't actually changed the structure at all. All that's happened is this imaginary line that you've drawn on the chart has broken. But in reality, the market is still moving in a clear phase of lower lows and lower highs. So if you were a trend line buyer and you tried to buy from here, you're going to lose because the market is still downtrending and you are therefore battling the trend. Now, if instead we did manage to get up and break this high, that would validate a change in the trend. And then you could go ahead and find opportunities to buy the other way because the market has broken out of its lower low, lower high phase and pushed instead into a higher high and higher low phase. But until that structural point there breaks, the real price structure, this trend line means nothing. And this is still a bearish market. Now, let me highlight what happens when we focus on trend lines over structure. Instead of winning your buy trade, you are very much likely to lose because you are fighting the trend. So from a trend line perspective, this looked like a viable buy, you would have lost. From a structure perspective, what do we have instead? Well, this formation of a lower low on this corrective move could have provided an opportunity for us to sell when we pair it with some other concepts. Therefore, we could have taken a profitable selling move here, so you could make potentially 3, 4, or 5% while the trendline trader is losing. Now, one thing that people get stuck with structure is looking at every single little intricate move and getting confused. So we're looking at a market here which is in a downtrend and then at the end shifts into an uptrend. We'll go through this as we go along. But what people will do is look at every single tiny little movement in the structure and treat that as significant structural breaks. So as you can see, I'm marking the price action up pretty much from candle to candle. This is how people look at structure. Then they get incredibly confused. Now that's totally fine. It's understandable. People are going to view structure this way, especially when you're first getting into the concept. But what I want to do to simplify your work, and this will take some practice from your side, but eventually you'll start to really understand how to do this, and it will become very, very simple to you, is to view structure as waves. So rather than viewing every single candle movement, we want to kind of zoom out and get a broad overview of the market. So in this market, which we can see is continually making these lower lows and lower highs, we would identify the structure in the format of waves. So we have this high, we can pull that down to this low. Then we have the pullback to this point. Then we have a new lower low. Then we have a new lower high. And then we have the new lower low all the way down here. We have a lower high, and then we have a new lower low. So let me explain how I've come to the conclusion here to mark the structure in this way. We can see this is a clear viable high. Then we have a clear viable low. Then we have the pullback forming a lower high. Then we come down in this clear movement and form a lower low. Then we have the lower high. Then we have the lower low. So although there's all this smaller structure within, and this will become relevant soon, don't worry, we don't need to consider every single small movement as a structural break. Because when we look at the higher time frame picture here, it's not. These small movements don't actually change the larger structure in any way because they are still confined within the range from the previous lower high to the previous lower low. So any structure that takes place here, yes, can be a valid trend and yes, can be traded. And this is called substructure, which we're going to get into soon. It shouldn't actually affect your view of the larger trend. Because if we consider this, even if this was a small uptrend, it didn't break past the previous lower high, meaning the market, on a big picture perspective, is still in a downtrend. So when we can start to view structure as waves in this manner, instead of pulling ourselves into every single tiny little movement that forms in the market, structure becomes a lot clearer and easier to understand. And as I say, it's going to take some practice, but you will get used to doing this and viewing the structure as larger waves. Some people nail it right away, some people will find some confusion. But like all concepts, practice will make you a lot better. So now let's go a little bit deeper into that concept of substructure. And I'll show you the two different formats of structure, which are swing structure and substructure, and how we can trade them successfully without getting confused. Market structure is a fractal concept, and that means the same price structure movements are going to occur on a very low time frame and also on a very high time frame. So you can look at the daily time frame, you can look at the 1 minute time frame, you'll see the same tendencies in the structure of the market. Now, because of this, within every larger trend, we also have smaller trends, and this creates swing structure and substructure. So let's take a look at this example. Now imagine this larger black line, which indicates the swing structure or the overall higher time frame trend of the market, is, let's say, the 4 hour time frame. Well, then within that, every upward move we have on the 4 hour and every downward move we have on the 4 hour can also form hourly, 30-minute, and 15-minute trends within. And this actually continually dials down. So then if we looked within the 30-minute trend, we would then see smaller 5-minute and 10-minute trends within. If we then looked at the 5-minute trend, there would be smaller 1 minute and 30-second trends within that. So no matter what time frame you're looking at, there's going to be a smaller version of new trends inside of that price action. And that is where the concept of the swing structure and substructure comes in. So substructure simply refers to the smaller trends happening within the swing structure movement. So if you're a trader who uses the daily, the 4 hour, and the 1 hour, well then the daily is going to have smaller 4 hour and 1 hour trends within it, and so on. Now there's one core way that we can take advantage of substructure. And the substructure that we ideally want to be trading is the substructure that takes place during the corrections or the corrective moves. So remember before we said the pro trend movements are impulses, the pullback moves are corrections. When we're trading the pro trend movements, it makes the most sense to just trade the swing structure. Trade the higher time frame, move with the higher time frame trend. But the pullbacks that we get, the corrective moves, actually provide smaller trends and generally provide new trading opportunities that we can capitalize upon if we understand and use this concept of substructure. So I've marked out these areas. This is ideally where the substructure will become useful to you, the pullback movements, and this is where the substructure trades become available. So the way that we would do this is when we're looking at a higher time frame trend, obviously that's going to be rather linear, just moving to the upside. But if we go to a lower time frame, so now focus on this green line, what we will actually start to see is smaller trends and trend reversals taking place within. And really quick guys, identifying a reversal is rather simple. We are looking for phases in the market where we shift from higher highs and higher lows into lower lows and lower highs. This change in the trend validates a reversal because it tells us that the market is no longer continuing with the impulsive pushes to the upside and is instead now impulsing to the downside. And that's a reversal from a bullish into a bearish trend. So that's the point where we would stop buying and instead start to sell. Now, if we were looking on the other side at the end of a downtrend to validate a change from the downtrend into an uptrend, we would look for a break from lower highs into higher highs. And then when the market forms and validates a higher low, that is where we would look to then start buying instead of selling. Now, after we see one of these lower time frame trend reversals, we would actually see opportunity to start selling through the substructure move. So if we're following a 4 hour uptrend, we might find a 30-minute opportunity to sell short term on the way down towards a more meaningful area in the swing structure. Then we can close our trade and look to continue with the swing structure once we start to see the market structure breaking. Then, if we see the same thing again, where a lower time frame is starting to break into a downtrend, we may have an opportunity to trade through some substructure before the swing structure movement continues. So, really, we can have one larger trade working through the swing structure, or a few trades where we're buying at the lows of each of the swing structural movements. But then within that, we can also find conflicting opportunities that will work for day trades, which are going to be these substructure pullbacks, which may provide lower time frame selling opportunities for us to take throughout the day while we wait for the swing structure to form enough strength for its next move. So now let's take a look at an example of the swing and substructure in action. Now here we are looking at GBP USD on the 4 hour time frame. And we can see quite visibly, if we consider the highs and lows, we have the high, then we have this low, which has broken structure here, making a lower low. Then we have a lower high, then we came down and we formed this lower low after breaking the structure just there. So viewing the structure in waves as we do, we can see we have the high, lower low, lower high, lower low. So we are in a confirmed downtrend. And the swing highs of the swing structure points would be first of all there, second of all here. So in order to change the trend direction, in order to start leading into buys, we would need to see this high break because we need the market to impulse into a new trend. At the moment, the impulses are pointing to the downside, so there is absolutely no reason why we should expect the market to do this until, of course, and unless, of course, we break that structural point. Now, as you are also going to see though, throughout the corrective moves, such as this one here, we have this smaller uptrend. So you can see the opportunities arise within these smaller moves. Now, we can actually buy through corrective movements if we have the right confirmations to do so, with the understanding and the rule that we should not look to take price further than the swing structure high. So let's dial in on this current example here. If we were looking at this trending structure, we have the swing structure move to the downside, but if the market structure shifted, we could potentially take a buy. However, any buy that we do take should only look to lead at a maximum up to this high and below this high. Because at the moment, with the swing structure still pointing to the downside, this high is going to hold significance. And unless this high breaks, we shouldn't look to buy past that point because it would be unconfirmed, and then we would be fighting the trend. So we can buy into an uptrend if we get one forming on the lower time frames, but at most we should look to target kind of high probability areas below this high. Okay. Now I trade using supply and demand. I'll put a card in the top of the video breaking down supply and demand if you want to go and watch a class on that. But supply and demand zones are essentially just zones where we've seen large amounts of selling or buying previously. A supply zone would look like this, where we mark the last candle before the impulse down. This is an area where lots of selling took place before, so the concept is when the market gets back to this point, it's likely to start selling again. So what does this do? Well, this provides us with an idea that this could act as a magnet for price, and this is where the next movement could come from. So if we were looking to continue the swing structure, our trade idea would be simple: sell from this supply. So when the market pulls into that area, we would place a sell order with a stop loss above the high and look to trade into a new impulsive leg of downward movement to continue the existing downtrend. And from a swing structure perspective, that means if structure allowed us to on a lower time frame, such as the hourly, we could buy towards that supply and use that supply zone as a target to then get out of positions on the buy side and lead into those positions on the sell side. So, providing the market gave us what we wanted to see in order to execute a trade here, we could buy through this substructure, and that is what provides these smaller trades. So as we can see now that we're on the hourly, we have indeed actually had a break of the structure just here. So we have this lower low structure forming and lower high structure forming on the lower time frames. And then we broke above the structure just here. So what we could do at this point is look for, once again, supply and demand. This time I'd be looking for demand, which is the last candle before this impulsive move to the upside. We would place a buy order just in this zone, and then we would position stops below, and we would use that higher time frame supply as a target. And now this would become a viable trade for us to actually take the market higher before leading into larger shorts. So we formulated two ideas. We have the swing structure move, which would be a sell from this zone, stop losses above, looking to trade into new low price. And we have this smaller idea taking advantage of this lower time frame structure to buy through the smaller range, targeting this area. Remembering that we can only look to trade within the swing structure range. We can't look to extend this trade further than that because the impulsive movements are telling us that the market is trending down. So now if we allow this market to play out, you see, we get the trade through that substructure before filling the swing structure trade and moving to the downside. Now, obviously, these are very loose examples, but I'm presenting you with what you can actually start to do. And a lot of the trades that I take actually take place within this substructure. And the great thing about the swing and substructure style of trading is that you always have the high time frame picture and the big picture narrative in mind. The higher time frames are almost always the most accurate time frames to be trading. So when we build our picture around those high time frames and then use these lower time frames to scale into our positions, we have high probability and a lot of clarity around what the market is doing. Before we finish up with today's class, I want to give you a very important tip. and that is validating reversals with body closures versus wicks. So before we spoke about how a shift in the trend or a reversal in the trend takes place when we shift from higher highs and higher lows into lower lows and lower highs, or vice versa if we're going from a downtrend into an uptrend. Now, one very important thing to note is that wicks do not indicate a break in the trend. Now, we have something called liquidity and liquidations that take place in the market. If you want to learn more about liquidity, card somewhere in the top video as well as in the description for a class on that. But basically, not every time that we break a structural point will the market continue into reversals. Sometimes the market will sweep a low, as we can see here, and then instead of reversing, actually go back up and make new highs in the trend. Now, in essence, what wicks are showing us is a rejection of momentum. So in this selling move, we have this higher low. We had a break here, which some people would see as a break in structure and start selling into, thinking this market is reversing. But if we consider what wicks show, they show rejected prices. So this shows the market attempted to reverse, but failed because we closed back above. In order to validate a reversal here, we would need to see candle body closures below this level. If we got a candle body closure, that would tell us the market is confirming a reversal. But this, with the wicks, is telling us we are rejecting a reversal. But let's just take a look at how the market played out here. You will see that instead of moving to the downside, we actually pushed up and made totally new highs in the trend. That's because we rejected the reversal with wicks. So remember, to validate a reversal, you need to see candle body closures. Wicks will not cut it because they're actually showing the opposite. They're showing a rejection of lower prices, which is generally going to lead into just continuations of further upside. So there you have it. There's pretty much everything you need to know about market structure in order to start trading the concept successfully. Now, if you want to go deeper into this concept and see how I build it into a system that consistently brings me results like this, and has helped people to achieve results like this trader who just made $11,000 last week, and this other trader who's now developed consistency and has made just over $5,500 in the past 2.5 months, then I will show you the systems I use to do that. Check out the top link in the description. I'll show you how I can give you a realistic outlook on trading and help you to achieve the full-time career that you're looking for. And if you're not interested in doing that, definitely check out the video somewhere here on liquidity. That is a really good one to watch following on from this class. That's all from me. Thank you for watching. I'll see you in the next video.